Holy. There she goes. Holy.
Hello everyone, John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. Thank you once again for tuning in and watching. That was a clip of the Canadian real estate literally collapsing. It was in Coquitlam, BC this week. And of course, there's going to be a lot of questions about that and how did it happen. Luckily, no one was hurt. Moving on to some more fires now. Our most recent fire was in Collingwood, Ontario. Fire destroys 4 townhouses under construction at Crosswinds Boulevard. The full contingent of firefighters from Blue Mountains responded to the blaze, as well as a crew and an aerial truck from Collingwood. So of course, now I have to add this to our list of new construction fires in Ontario. Here they are. This is from December last year to November this year. I'm probably going to update that even further if there's more in December. But there is the new one at the top. 4 Collingwood townhomes started at 5:20 a.m. on November 30th. So another early morning fire when nobody was working there. And it is under investigation. So of course, we'll keep an eye on that and keep adding to that list if there is more to come. I'm guessing there will be. Next, I want to talk about the interest rates. A lot of talk with interest rates are going to be dropping, and will the Bank of Canada, drop their rates sooner than expected, and analysts and markets pricing in interest rates and whatnot. So I just wanted to touch on one article I found in the last week, and it kind of is the most updated sentiment, I guess, from the Bank of Canada and some economists. From the Financial Post on November 30th, why the Bank of Canada could cut interest rates much more than markets expect. This economist see 200 basis points of cuts in 2024. Of course, this economist say that it could happen like that. It's not that it will, but I'm going to just take a few parts of this article that I thought were relevant to what I have to say. The Bank of Canada is widely expected to hold its benchmark interest rate when it meets next week, but a lot has changed since October. Cooling inflation here and south of the border, a weakening economy have turned markets' attention from rate hikes to rate cuts. Investors are now fully pricing in a 25 basis point rate cut by April, a 75% chance by March, and even a 20% chance by next week. Despite some tough talk on inflation, Bank of Canada Governor Tiff Macklem has now dangled the prospect of rate cuts a few times, said Brown. The governor repeated last week that cuts can begin before inflation falls to the 2% target, as long as there is a clear trend that it is headed that way. Seems like everyone's getting worried about the economy now, and of course rate cuts are the next thing. But of course we know when rate cuts happen, it's not for a good reason. One sticking point could be the housing market. While home prices are coming down, the bank may take a more cautious approach to avoid fueling another rally. Yes, the sales to new listings ratio recently fell to its lowest since 2013, meaning that home prices could drop even more than 5%, Capital is predicting by March. At a time when house price declines are gathering pace, right now one can just as easily make the opposite argument that the bank will need to act aggressively to prevent the housing market from falling into a tailspin, he said. So there's a lot of concern right now over the housing market. Interest rates are one thing, but the housing market seems to be, and it always has been, the main focus or one of the main points that the Bank of Canada needs to consider before making any decisions. Of course, if they start cutting and give the impression that they're going to keep cutting, the housing market might take off again in the wrong direction. And at the same time, if they hang on too long or keep rates high for too long, the impact, they won't see that for 18 months and the damage will be done and it could be catastrophic. So of course, they're still walking this fine line, but we'll see what happens. And of course, it looks like this week we're going to see another pause. And of course, interest rates are really starting to take their toll on the economy right now. Anyway, let's look at some stats from across Ontario and Calgary. Early stats for November. Not a lot of places have reported by the time I made this video, but we're going to go over what we have. So if you don't see your place, hold tight. I'll probably have it next week. First of all, looking at the month-over-month price changes from October to November this year. Barrie and District dropped over 10%, 10.7% in 1 month. Georgian Bay, 8.4%. Brantford down 8.2% in 1 month. Lakelands and Muskoka down 4.9%. Peel region 3.7%, Kitchener-Waterloo down 3.1%, London St. Thomas down 2.9%, City of Toronto down 2.9%, Durham region down 2.7%. So it looks like we're seeing a lot of the major metropolitan areas having those decent sized month-over-month losses, and they kind of generally lead the market. Calgary down 1.3%. Grey Bruce, Owen Sound down 1.2%, and then the rest, the next few there, Hamilton, Burlington, Oakville, Milton, Kingston and area, fairly flat, down just under 0.5% for most areas. And then we did see some small gains in York and the Niagara region, and some pretty decent month-over-month gains, 5.9% in Cambridge and 6.7% in Guelph. Now let's take a look at the overall losses from the peak. The Southern Georgian Bay leads the way right now. Wow, that's 32.3%. A lot of cottages in this area, so of course you're going to see smaller prices in the winter when they're not selling the cottages and the lakefront stuff, but still 32.3% decline from the peak, followed by Brantford 28.2%. And of course Brantford's one of those speculative suburban areas, right, that would be hit hard. They had big run-ups, they're going to have big losses. Berrien District down 27.9%, Durham region down 27%. London St. Thomas down 27%, Kitchener-Waterloo 25.7%, Lakelands down 24.1%, Peel down 23% from the peak, Hamilton Burlington down 23% from the peak, Cambridge also 23%, Niagara region, Oakville, Milton, and Kingston and area just over 20%, and Grace Brew, Owen Sound also in that same boat, 20%, and then you get down to the lesser losses or the lower amounts losses. Guelph 16.5%, York 16.4%, Toronto down just under 13% from the peak, and of course Calgary has fared the best at 2.4% from their peak, which was the most recent peak this year. Now looking at those losses in dollar numbers, and there's some pretty big numbers here, and not just from one place. We're seeing it in 4 places now are over $300,000 in losses. And this doesn't include the Fraser Valley this week, which they were well over 300, I believe, last time I checked. But Southern Georgian Bay down 360,000 on average from the peak. That's a huge number. Durham region down 333,000. Oakville and Milton down 326. Peel region 312. Berrien District 282, Brantford 258, Kitchener-Waterloo down 258, Lakelands down 257, York down 256, Hamilton Burlington down 250,000 or 243,000 on average, Cambridge down 242,000, London St. Thomas down 222,000, Niagara region 186 grand, Guelph 175, Grey Bruce, Owen Sound 162, Toronto, City of Toronto, not a lot percentage wise, but they are down 160,000 on average. Kingston and area 150 grand, and Calgary just down 13,000, so pretty much even, not a big loss there at all. And lastly, let's see who's in buyers markets and balance markets and whatnot with the market balance. This is again based on the sales to new listings ratio. This is how one measure, I guess, to decide on what kind of a market it is. And in the buyers markets right now from this week's data, we have Southern Georgian Bay, the Niagara region, Toronto, Peel, Barrie, and District. And you can see all the balanced markets there. York, Durham region, Kingston and area, London, St. Thomas, Brantford, Lakelands, Hamilton, Burlington, Guelph, and Cambridge. They are on the buyer's end of the balanced market, but they're still a balanced market. And then you get into that 50% range. You have Grey Bruce, Owen Sound, Oakville, Milton, Kitchener-Waterloo, and of course, not a lot of inventory still in Calgary. They are in a seller's market, an overheated seller's market at 81% sales to new listings ratio. But again, we're seeing that they have a lack of new listings, but their prices are not increasing. So it kind of goes to show you the underlying issues with affordability and house prices and interest rates, even though they are at that lower average price than Ontario or BC would be. Anyway, that's it for this week. I'm going to have a great update next week on the rest of those areas, and I'm sure there's a lot of things happening. As always in real estate, we have the new rules that have come into effect. I've dealt with a few offers already, but nothing exciting yet. The games have still yet to start, I guess I should say. Anyway, until next week, I'll see you then.